Welcome back to the deep dive. Our mission here is, well, it's always the same. We take a huge stack of dense source material, we dig through it, and we try to find the most crucial, the most surprising, and honestly, the often hidden nuggets.
All to give you the shortest path to being genuinely well-informed on a topic.
Exactly. And today, we are strapping into the driver's seat of a financial decision that, almost all of us make at some point. We're talking about buying or leasing a car.
And this really isn't just a conversation about, can I afford the monthly payment? It's a deep dive into this vast, incredibly complex ecosystem.
Right.
You've got high-value financial products, you have these really detailed legal contracts, and critically, there's a whole history of regulatory oversight that tells a story about where the system has failed consumers in the past.
If you've ever felt that, that little pit in your stomach when you're sitting in the dealership's finance office, today's deep dive is definitely for you. Absolutely. We have been poring over, just reams of documentation all about car loans, leasing structures, the very specific mechanics of dealer financing. And our goal isn't just to define the terms.
No, it's about understanding the fundamental legal and financial structures behind how you get a car. We're really focusing on how revenue is generated after you've already agreed on the price of the car itself.
That's the key. We are hunting for those areas of opacity, the hidden costs, the leverage points, all the things that separate a good deal from a really, really expensive one.
And before we get into the nuts and bolts, we have to establish the sheer scale of what we're talking about. This is not some fringe market.
Not at all.
The vast majority of people buying a car are participating in this debt ecosystem, whether they fully realize it or not.
Let's throw the numbers out right away because they are, frankly, staggering. Over 85% of all new cars sold.
85.
And about half of all used cars are acquired using some form of financing. We're talking about installment borrowing.
So that means fewer than, 1 in 7 new car buyers are walking in and paying with a lump sum of cash.
Right. Financing is absolutely the rule, not the exception, in the entire automotive world.
It's the engine of the industry. You have to think about it. Without consumer financing, the current scale of the auto market would collapse.
And this isn't some new thing either. I think a lot of people assume it just kind of grew organically.
Right, but if you want a really surprising historical anchor for how massive and debt-driven this whole sector is, you can trace its inception back to a really crucial strategic move over a century ago.
This is the part that I found really interesting. We sort of assume that car financing grew out of banks slowly deciding, oh, we should offer auto loans. But the sources point to a very specific corporate intervention that changed everything.
It did, and it happened right around the time of World War I.
Okay, so when was this?
Specifically, 1919, with the launch of the General Motors Acceptance Corporation, or GMAC.
GMAC, right.
General Motors was looking at the rising price of their own cars, and they had this realization. The average person just did not have the cash on hand to buy one outright.
So if they wanted to grow,
If they wanted to move from being a niche luxury maker to a true mass-market company, they had to build the financial infrastructure to support it themselves.
so instead of just waiting around for traditional banks to catch on and start offering loans for cars,
They created their own lending arm. And that single move, it basically nationalized the whole concept of the installment plan for huge purchases. It fundamentally changed how we as a public consume durable goods, especially cars.
so financing went from being a convenience to an absolute necessity for the industry to even exist at the scale it does today.
It was a recognition that credit is inventory. The more people who could get credit, the more cars GM could sell.
Right.
And that system, the one pioneered by GMAC, which is now LA Financial, by the way,
Right.
that created the template for the enormous indirect lending market we're going to be talking about today.
That sets the stage perfectly. So what's the roadmap for this deep dive? First, we're going to define the two main paths to getting a vehicle that's direct versus indirect financing.
And we need to spend some real time dissecting the, let's say, controversial dealer markup and all those costly financial add-ons.
Yep. Then we'll pivot to look at the mechanics of car leasing, which is a whole different animal. And finally, we have to cover this high-risk, super high-pressure sales tactic that's known as spot delivery.
It's a full roadmap, and it's really designed to empower you with the specific knowledge you need to, look past the glossy brochures and actually understand the legal reality of the contracts you're being asked to sign.
Okay, let's unpack this and dive into section 1. The two paths to car ownership: direct versus indirect financing. We've already established that a huge number, 85% of new vehicles, are financed. So the question is, how are people actually getting that money?
Right. We're talking about structured installment borrowing, and this is a global thing. The specific names and the legal structures, they vary a bit depending on where you are.
Like in the UK, for example.
In the United Kingdom, for example, they have very well-established comparable options. You've got your standard car loans, which are pretty straightforward, but then you have something called a hire purchase agreement.
And what's that?
It's a different legal setup where the buyer doesn't technically own the car until the absolute very last payment is made.
Right.
And of course, they have leasing, which they call personal contract hires or personal contract purchases.
But the core idea is the same.
The fundamental essence is identical. You're borrowing money to use or to eventually own a valuable asset, and you're paying it off over a set amount of time.
But the really critical difference, especially in the U.S. context where our source data is from, is how that money is sourced. And that brings us to the big distinction: direct versus indirect financing.
Direct loans are by far the simpler and more transparent way to go. This is when the borrower, you, proactively goes out and arranges the loan directly with a lender.
A bank, a credit union.
A bank, a credit union, an online lender, whatever. And the key is you do this before you ever set foot in the dealership.
You're essentially shopping for the money first, then the car second.
Precisely. You get a commitment from the lender. It might be a pre-approval letter or even a draft check. And when you go to the dealership, you negotiate the price of the car completely separately from the price of the money.
You walk in with your funding already lined up. That must give you a lot of leverage.
Huge leverage. You can basically act like a cash buyer. It's clean, it's borrower-initiated, and it separates that sales conversation from the finance conversation, which is so important.
That really sounds like the ideal, most consumer-friendly way to do it. But you said the vast majority of people don't do this. They use the second path, indirect financing or dealer financing. Why?
One word: convenience. It's the primary driver. Indirect financing is all handled by the dealership itself, right there at the point of sale.
It's the one-stop shop approach.
Exactly. The dealer offers to handle the whole thing. You pick your car, you haggle over the price, and then they say, hey, why don't we just find you the best rate right here in our office?
And this is where that subtle but absolutely essential legal twist happens that I think catches a lot of people by surprise. What is the legal nature of the contract you're actually signing with the dealer?
This is the aha moment. This is what changes how you should view dealer financing. Legally, and the sources are very clear on this, indirect financing is not a technical loan agreement between you and the car dealer.
Wait, hold on. If I'm signing paperwork that says I have to make monthly payments plus interest for, say, 5 years, how is that not a loan?
Because the dealer is fundamentally a retailer. They're not a chartered bank. So what you're signing is what's called a retail installment sales contract, RISC.
Oh, RISC. Okay.
That is the foundational legal document. And you should think of the RISC as a contract that governs the sale of a piece of merchandise, the car, and your promise to pay the dealer for that merchandise in scheduled installments over time.
So it's an agreement to buy, not an agreement to borrow money from the dealer.
You've got it. It's a promise of payment. And the dealer who holds that RISC wants to get that contract off their books as fast as humanly possible.
Right, because they don't want to be in the business of servicing debt or chasing down monthly payments.
No, they're in the business of selling cars, not collecting interest. So what they do is they immediately sell or assign this RISC to a third-party financial institution.
And that would be a big bank, a credit union, or one of those captive finance companies like Toyota Credit or Ford Credit.
Exactly. The dealer is basically selling your IOU to the bank, and the bank then becomes your actual lender.
So that's why the process seems so fast and seamless. The dealer isn't starting from scratch. They already have these relationships in place.
They do. The dealer knows in advance which financial institutions, which are called indirect auto lenders, will buy a given contract based on the buyer's credit score and the terms. They're effectively acting as a broker.
Packaging up the sales contract and shopping it to their network of lenders.
Precisely.
Yeah.
And the consumer, you rarely sign a new contract directly with the bank. Your legal obligation just transfers over when that RIC is assigned.
So you don't sign a new loan agreement, you just start getting bills from a bank instead of the dealership.
Correct. The first document you sign to that finance office is the only document governing your obligation. And the dealer's ability to act as this financing middleman through the RISC, That's what gives them so much control over the terms,
Especially the interest rate.
especially the interest rate, right at the point of negotiation.
That distinction, RISC versus a direct loan, that feels incredibly important for people to understand. So let's talk about the volume again. If this direct method is simpler and more transparent, why does the indirect dealer arranger route just completely dominate the market?
It's the path of least resistance. It's just so easy.
Oh, yeah.
According to 2023 data from the National Automobile Dealers Association, or NADDINA,
Okay.
roughly 75 to 80% of all new vehicle sales in the U.S. involve some form of dealer-arranged financing.
So 4 out of 5.
4 out of 5. The convenience is enormous. You find the car, the dealership runs your credit one time, and then they come back and present you with several financing options almost instantly.
But what that statistic really says is that in 4 out of 5 transactions, the consumer is prioritizing speed and ease over potentially getting a cheaper loan. Why is that specific 75 to 80% number so important to, say, regulators?
Because if the overwhelming majority of people are entering car ownership this way, through this indirect mechanism, then any structural flaw in that process,
Right.
any systemic source of, cost inflation or unfairness is going to impact the entire market. If it was just 10% of buyers, maybe the regulatory focus wouldn't be so intense. But when it's 80%, the potential for widespread consumer harm is massive.
Yeah.
And that's why we have to spend the next section dissecting exactly how that cost gets inflated.
That brings us perfectly to Section 2. Dealer financing, the markup mechanism, and regulatory scrutiny. We've established the RISC as the legal foundation, but now we have to get into the weeds. We need to dissect the mechanism that actually creates revenue for the dealer beyond just the profit on the car itself.
This is the core insight into how indirect lending works. The entire system is intentionally built to reward the dealer for arranging the finance.
And that reward comes directly from the customer.
It comes directly out of the customer's pocket through the interest rate. So we need to be really clear about the specific terms that govern this whole revenue generation process.
Okay, let's start at the bottom. What's the base rate, the absolute minimum cost of the money?
That is called the buy rate. This is the interest rate that is set by the indirect auto lender, so the bank or the finance company.
And that's based on my credit profile.
Primarily, yes. Your FICO score, the length of the loan, what the market rates are doing. It's the fixed rate the lender is willing to accept to purchase that RISC from the dealer and take on the risk of the loan.
And the customer never sees this number.
Almost never. Not unless you specifically ask for it, and even then, the dealer is under no legal obligation to disclose it to you.
So the buy rate is the true wholesale market rate for that specific borrower. Then the dealer steps in.
And this is where they exercise their discretionary power, and it's where their profit comes from. They add a markup to that buy rate.
And this markup is completely discretionary.
It's the discretionary factor. Lenders will typically allow the dealer to mark up the rate by a certain amount, maybe 2.5 percentage points. The limits vary, but the dealer decides, based on the negotiation or possibly other factors, exactly how much of that allowable markup they're going to apply.
So you have the buy rate plus the dealer's markup, and that equals the final higher interest rate that they present to the customer, and that's called the contract rate.
Exactly. The contract rate is the number on the paper that the customer signs off on. So if the bank offered a 4% buy rate and the dealer decided to add a 2% markup,
The customer is told they qualified for a 6% loan.
they qualified for a 6% contract rate. Yes.
And the dealer's compensation from that, how much of that extra 2% markup do they actually get to keep?
They often keep most of it, if not all. That difference between the buy rate and the contract rate, that entire markup, is the dealer's compensation, and it's referred to as the dealer reserve.
It's a really powerful financial incentive structure.
Absolutely. The higher the interest rate the dealer can convince the customer to accept, the larger the reserve payment they get from the bank when the RISC is assigned.
This inherent conflict of interest is what makes this whole thing so complex for the consumer. The dealer's motivation just shifts dramatically.
It does. They're no longer just motivated to sell you the car. They are now equally, if not more, motivated to sell you the most expensive financing package they can get away with, because that can generate thousands in pure profit from the reserve.
And it creates this negotiation where you, the customer, are basically fighting a battle on two fronts at the same time. There's the gross profit on the vehicle itself, and then there's this hidden, separate negotiation over the reserve profit on the loan.
And since most consumers are laser focused on that monthly payment figure, the dealer can often hide the higher interest rate. They'll just extend a loan term out to 72 or 84 months, maybe knock a couple $100s off the car's price.
So the payment looks affordable.
The payment looks affordable, but it ends up costing you far, far more over the life of the loan.
Let's make this concrete. We need to walk through a real-world example of what this discretionary markup really costs someone. Let's say we have a $35,000 car financed over a pretty standard 60-month or 5-year loan term.
Perfect way to illustrate the difference.
Mm-hmm.
So let's assume the bank's buy rate for a well-qualified buyer is a competitive 4%.
Okay, so at 4% on a $35,000 loan over 5 years, the total interest you'd pay would be about $3,674. Your monthly payment is manageable, around $644.
Now let's say the dealer decides to exercise their full discretion. They apply the maximum, let's say a 2 percentage point markup, that takes the contract rate up to 6%. And the consumer agrees, totally unaware that the dealer was offered 4.
Now the math changes completely. At 6%, the total interest paid rockets up to about $5,559.
So the difference in the total cost to the borrower is nearly $1,900.
Just in extra interest.
Just in extra interest, simply for the privilege of having the dealer act as the middleman and mark up the rate.
And that $1,900, or a big chunk of it, that becomes the dealer's reserve, paid to them by the bank. That is a massive profit margin for just what? Filling out some paperwork?
And remember, the sources said that dealer markups can result in hundreds of dollars in additional costs. Well, $1,900 over 5 years is almost $400 extra per year. That fits the description perfectly.
It really just shows that the convenience of dealer financing comes with a verifiable and potentially very substantial cost premium. But that $1,900 is often just the beginning. It gets compounded by something even more insidious, right? The add-ons.
Exactly. The total cost of financing isn't just about the interest rate markup. Dealers will frequently bundle all sorts of other financial products into the loan. This inflates the principal balance, sometimes dramatically.
Which means you end up paying more interest on the car, more interest on the markup, and more interest on whatever product they just sold you.
It's a triple whammy.
Let's spend some time on the major culprits here, starting with gap insurance. What is it, and why is it so often a source of inflated cost?
Gap insurance, or guaranteed asset protection, it covers the difference, the gap, between what you still owe on your loan and what your car insurance company will actually pay out if your vehicle is totaled or stolen.
Because cars depreciate so fast.
Instantly. For the first few years of a loan, you almost always owe more than the car is actually worth. So gap insurance is a legitimate product for a lot of buyers, especially if you have a small down payment or a really long loan term.
But the sources we looked at are very clear that when you buy it through a dealer, the cost is often highly inflated.
Immensely inflated. If you were to buy gap insurance directly from your own auto insurer or a third party, it might cost you, say, $300 to $600 for the entire life of the loan.
At the dealership.
Dealerships routinely charge $800, $1,000, even $1,200 for the exact same coverage. Then they roll that into your principal balance, and you pay interest on top of that inflated price for years. The profit margin for the dealership on that one add-on can be well over 50, sometimes 100%.
Wow. So that immediately adds hundreds, maybe $1,000 to the principal. And now you're paying 6% interest on that extra grand. It's a double hit of profit generation.
Yeah.
What about the other big one, the extended warranty?
The extended warranty, or vehicle service contract, VSCs, are another huge revenue driver.
Yeah.
A VSC is basically an insurance policy that covers certain mechanical failures after the original factory warranty runs out.
And again, not necessarily a bad product in itself.
No, not at all. But the dealer's involvement is what complicates it. The profit margins for dealers on VSCs can easily exceed 40% and sometimes much, much higher depending on the provider they use.
And the price they quote you in the finance office is not set in stone.
Not even close. It's often heavily negotiable, but because it's presented in that high-pressure closing environment, consumers feel like they have to accept the first price they're given. And that's typically $2,500 to $4,000, which is immediately rolled into the loan.
When in reality.
In reality, savvy consumers know they can usually buy the same or even a better policy online or sometimes directly from the manufacturer for significantly less money, even after they've left the dealership.
So the combination of the discretionary interest rate markup and then bundling these high-margin add-ons can easily add thousands and thousands of dollars to the total cost of owning that car. This brings us to a critical issue: regulatory scrutiny. Why does this discretionary markup become such a flashpoint for agencies like the Department of Justice, the DOJ, and the Consumer Financial Protection Bureau, the CFPB?
Because of what they found. They found evidence of discriminatory practices that stemmed directly from how opaque this whole system is. Regulatory bodies got intensely concerned because the variation in the interest rates being charged to consumers.
The application of that markup.
Yes, that variation was often found to be not correlated with the consumer's actual credit risk.
So if you have two borrowers, identical FICO scores, same income, buying the same car, they should theoretically get the same buy rate and the same contract rate. But that's not what was happening.
It was not what was happening. The investigations from the DOJ and the CFTB focused on a legal concept called disparate impact.
And what does that mean exactly?
Disparate impact essentially means that even if a policy or a mechanism like the discretionary dealer reserve is neutral on its face, if it results in significantly unequal outcomes for protected groups, based on race or ethnicity, for example, then it's deemed discriminatory and it's illegal under fair lending laws.
So the dealer reserve system gave finance managers the power, the discretion to apply these markups. And the data showed that this discretion was being used disproportionately to charge minority borrowers a higher rate than their non-minority counterparts who had the exact same credit profile.
Precisely. The dealer might try to rationalize it and say the higher markup for one customer versus another was just negotiation skill. But when you analyze it on a massive scale, the data revealed a very clear pattern of bias.
A systemic bias.
Yes. For instance, in some of the big enforcement actions, it was found that minority borrowers were twice as likely to be charged the absolute maximum allowable markup compared to equally creditworthy white borrowers.
That is a staggering statistic. And it's a powerful demonstration of how systemic bias can be embedded in what seems like a neutral financial structure. Let's get into the specific examples of enforcement actions from the source material because they really establish this whole regulatory pattern.
Okay, so the first major action that was cited was back in 2013. It was a DOJ and CFPB order against Ally Financial, which, as we mentioned, was the old GMAC.
Right.
Ally was ordered to pay $98 million to address their discriminatory loan pricing practices. And that sent a huge message across the industry. The federal government was going to hold the lender responsible for the discrimination that was being created by their dealers' discretionary markups.
So that set the precedent. Then just 2 years later, in 2015, we saw a similar resolution with Honda, again over discriminatory auto loan pricing. The focus wasn't going away.
And then perhaps the most well-known case cited in the sources was the 2016 settlement that involved Toyota Motor Credit. They were also found to have engaged in racially biased auto loan pricing through the exact same discretionary mechanism.
So the common thread across Ally, Honda, and Toyota is that they all use this indirect financing model where the dealer was given too much discretion over the final interest rate.
Absolutely. And the cumulative effect of these cases highlights a critical point for you, the consumer. The opacity and the discretion built into the indirect lending model were proven to facilitate unequal outcomes. And while regulatory pressure has forced lenders to increase their controls, the fundamental structure of the dealer reserve still exists today.
So what does that mean for someone buying a car now?
It means you, the consumer, must always assume that the rate you are being offered is marked up. You have to be prepared to demand to know the buy rate, or even better, come in with a competing direct loan offer. That is the only guaranteed way to neutralize the dealer's discretionary pricing power.
We have spent a lot of time unpacking the complexities of financing a car through a loan, whether it's direct or indirect. Now we really need to shift our focus to a completely different method of getting a vehicle. Leasing. This is section 3. Leasing and high-risk delivery methods.
Leasing is so often misunderstood. People think it's just a long-term rental, but it's not. It's a very specific contractual agreement between the lessor, that's the owner of the vehicle, usually the finance company, and the lessee, which is you, the user.
And the key to understanding a lease, especially compared to a loan, is realizing what you are actually paying for. With a loan, you're paying for the entire car plus interest, with the goal of eventually owning it. A lease is fundamentally different.
That's exactly right. The source material makes it very clear that with a lease, the lessee pays a fixed monthly payment for the privilege of driving that car for a specific term and a specific mileage limit. But crucially, you are only paying for the value of the vehicle that you use up during the term of the lease.
You're paying for the depreciation.
You are paying for the depreciation, not the entire purchase price of the car.
Okay, so if a car costs $40,000 new and my lease is for 3 years, and the car is expected to be worth, say, $25,000 at the end, I'm only paying for that $15,000 difference in depreciation plus finance charges.
Precisely. And that brings us to the absolute core of how a lease payment is calculated. It's something called the residual value. Lenders calculate lease payments based on what they estimate the car will be worth when that lease is over.
So if a car is projected to hold its value really well, if it has a high residual value, the amount of depreciation you're on the hook for is smaller.
And therefore, your monthly payment is lower.
This is such a critical insight because it means a vehicle with a higher sticker price, a higher MSRP, might actually have a cheaper lease payment than a physically similar vehicle with a lower MSRP, just because the more expensive car is expected to retain its value better.
It's exactly right. Think about a really popular high-demand pickup truck or a specific Japanese SUV model. They're known to retain, say, 65 or 70% of their value after 3 years.
A high residual.
A very high residual value. That means you are only financing 30 to 35% of the vehicle's price over the lease term. Now, contrast that with some niche, fast-depreciating luxury sedan that might only retain 45% of its value. You're financing 55% of the initial price, which leads to much higher payments, even if the starting price of the two cars was similar.
So the residual value is the single biggest factor in your monthly lease cost.
It is. And we also have to talk about the finance charge in a lease, which has a deliberately confusing name. The money factor.
The money factor, I've seen this. It's always some tiny decimal number.
Yes, it's the rate the lessor charges you for using their money. It's the equivalent of the interest rate in a loan. But it's presented as a tiny decimal, like 0.00250, specifically to obscure the actual interest rate.
Okay, so how does the consumer translate that tiny number into something they can actually compare to a normal loan APR?
It's a simple but absolutely necessary mathematical trick. To convert the money factor to an approximate annual percentage rate, or APR, you just multiply it by 2,400.
2,400, okay.
So a money factor of 0.000250 multiplied by 2,400 gives you an effective APR of 6%. If a dealer quotes you a money factor, you have to do that quick calculation to understand the true cost of borrowing. And just like the buy rate in a loan, the money factor is often subject to dealer markup, though the regulations on that can vary.
So understanding the residual value and the money factor lets you see the two core components of any lease payment. That covers the structural side. Now, let's pivot sharply to an issue that affects both loans and leases. A major consumer risk tied to the high-pressure sales process itself, spot delivery.
Ah, yes. This is where the emotional pressure of buying a car is leveraged against the buyer's financial safety. And it often leads to what consumer protection groups call a yo-yo sale.
Let's define spot delivery clearly for everyone listening.
Spot delivery, or spot financing, is when a vehicle is physically delivered to the buyer. They get the keys, they drive off the lot, before the financing on that vehicle has been fully completed and finalized by the actual lender.
And this usually happens in specific situations, right? It's not the norm for every single sale.
Absolutely.
Yeah.
It most often happens on weekends, late at night, or on holidays when the banks and credit unions are closed and that final electronic approval and contract assignment just can't be completed. But the dealer, they want the sale marked as done. They want the inventory off the lot, and they want the buyer emotionally committed to the car.
And that emotional commitment is the dealer's leverage. Once you drive that new car home, you show it to your friends, you put your stuff in it, you park it in your driveway, you are psychologically invested. You do not want to give that car back.
That's the whole game. The danger is in the instability of that initial contract you signed. It almost always includes a crucial but often overlooked clause. It's known as the condition precedent.
And what does that mean?
It basically says that the deal is only fully binding if the dealer can successfully find a lender who is willing to buy the RASC contract at the terms you initially agreed to. If they can't find a buyer for that contract, the dealer retains the right to unilaterally void the entire deal.
This is why it's called yo-yo financing. The dealer lets you drive the car away, that's the out on the yo-yo, but they keep hold of the string so they can yo-yo the deal right back into the dealership if the original terms get rejected by the bank.
And the scenario that unfolds is just. It's deeply manipulative and problematic for the consumer. Days, sometimes a week later, the bank officially declines the deal. Maybe the buyer's credit score wasn't quite high enough for that low buy rate the dealer promised, or maybe the dealer just couldn't get the profit margin they wanted on the reserve.
So the dealer calls the customer.
They call the customer and demand they come back to the dealership immediately to, as they say, recontract, to renegotiate.
And at that point, the dealer holds all the cards.
They do. The dealer might tell the customer, sorry, you have to accept a dramatically higher interest rate, or you need to come up with another $2,000 for the down payment, or they'll stretch the loan term out even further just to make the payment feasible.
And if the buyer refuses?
The dealer demands the car back. But by then, the buyer's original trade-in vehicle might have already been sold, or at the very least, its value has depreciated further, leaving the buyer completely stranded.
So the customer is now negotiating under extreme duress. They're worried about being embarrassed, about losing their transportation, about losing the equity in their trade-in. It's a classic high-pressure tactic.
It is, and it's why many states have enacted specific consumer protection laws to restrict or even ban spot delivery unless the financing is fully finalized.
So what's the key step for a consumer?
If you do agree to take a car on the spot, you must meticulously review the contract for any of those condition precedent or subject to financing clauses. And you have to get a copy of that signed contract showing a definitive date by which the financing must be finalized. And confirm in writing that the dealership has not sold or altered your trade-in during this conditional period.
Or a better strategy.
A much better strategy is simply to refuse to take delivery of the car until the bank has provided final, non-conditional approval, no matter how late in the day it is.
That transition from structured finance to these high-risk sales tactics really highlights the volatile environment of car buying. We've gone from the macro scale of, 85% debt dominance all the way down to the micro scale of a predatory tactic on a sales floor. This has been a true deep dive into the financial machinery of buying a vehicle. We have covered a tremendous amount of ground. We've gone from historical context and legal contracts all the way to controversial markups and very specific consumer risks.
So it's time for the key takeaways for you, the learner. This is how you can synthesize this knowledge and actually use it the next time you're in the market for a car.
Okay, first, you have to remember the crucial distinction between a direct loan, which you arrange yourself, and that legally distinct retail installment sales contract, the RISC, that's used in indirect financing. When you finance through a dealer, you are signing a sales contract that they fully intend to sell to a third-party bank, which allows the dealer to act as a financial middleman.
Second, and this is absolutely vital for your wallet, you have to internalize the mechanism for dealer profit that exists outside the car's price. That is the discretionary markup that gets added to the lender's baseline buy rate. That markup creates the dealer's compensation, the dealer reserve, and that reserve is negotiable. It is a cost you are paying that is not reflective of your creditworthiness.
Third, connect the dots when it comes to the hidden costs of add-ons. You have to be extremely wary of products like gap insurance and extended warranties when they're bundled into the financing by the dealer. Their massive profit margins inflate your principal balance and, so that means, your total interest paid, often by thousands of dollars over the entire term of the loan.
Fourth, when you're considering a lease, you need to focus on the two non-obvious factors. First, the residual value, which determines the depreciation part of your payment, and second, the money factor, which you must multiply by 2,400 to understand the true cost of borrowing in terms of an APR. Remember, a car with a high residual value will almost always be cheaper to lease.
And finally, be fiercely protective of yourself against high-pressure sales tactics like spot delivery, which is also known as yo-yo financing. Never, ever drive a vehicle off the lot until you have confirmed final, non-conditional approval from the lending institution. The moment you take possession before it's finalized, you transfer all the risk of that deal falling apart directly onto yourself.
These concepts, the RISC, the buy rate, the dealer reserve, and yo-yo sales, they're really the four pillars of financial literacy that you need to effectively challenge the sales structure that's built around dealer convenience and to maximize your own cost savings.
We established that dealer markups and these bundled add-ons consistently result in higher overall costs for consumers when you compare it to direct lending. And yet, 75 to 80% of new car sales still rely on the dealer acting as that financing intermediary. This is the cost of convenience versus the cost of effort.
So given that reality, the final provocative thought is this. If gathering a pre-approval letter from your credit union or your bank Getting a competing fixed direct loan offer is the single most effective tool you have for neutralizing the dealer's discretionary markup power. What specific friction points are preventing the vast majority of consumers from just taking that one simple step? And how can you, now knowing that the mathematical benefit is worth potentially thousands of dollars, ensure that the convenience of one-stop shopping doesn't ultimately cost you far more than the effort you saved?
That is the financial complexity we all face in this system. Thank you for joining us on this deep dive into car finance. We hope this knowledge empowers you to negotiate your next vehicle purchase with genuine confidence.
Until next time, keep digging into the details.